If you've been looking for a comprehensive guide to investing on the stock market in 2023, this is the one for you. We'll be unpacking all of the numbers as well as the predictions about where things will head, but we'll also take a look at the risks and opportunities about where things currently stand too. Of course, we'll look at this at a stock market level, but also for the global economy. Now, if you're wondering how we came onto this video idea, I was looking through Bloomberg and they publish a range of different forecasts about all manner of things. Today, we'll take a look at many of these predictions and numbers, but there was also a range of other data sources and due diligence that I've been looking through that I wanted to share and talk through together as a community. As we know, 2023 is shaping up to be a fascinating year after what was a tumultuous 2022. Of course, nobody knows where things will head, but I'd love to know your thoughts, so drop in a comment below. We've also just dropped and made the ASX Investor Instagram page, releasing daily pieces of news and market updates. So come say good day, there'll be a pinned comment at the top where you can come and join. And of course, I'm not a financial advisor. Nothing we talk about is financial advice. A lot of this is just forecasts. As the old quote goes, all models are wrong, but some models are useful. However, I think it'll be a fascinating discussion for us to go through. With all of that, let's get into it. So, where do things currently stand? 2020 was a tumultuous year. Global markets down by 20-30% depending which indexes you're looking at. Of course, the consensus for where things currently are is that a recession is likely for 2023. Now, it's fascinating because there's divergent opinions about how things will play out, but if you want the consensus view at the moment, based on a range of different analysts and economists, it is that the European region is heading into recession, either early 2023 or many forecasters are stating that they may have headed into it in Q4 of 2022. The US economy is likely to head into recession later on into 2023, and fascinatingly, China is likely to have a strong year of growth. Of course, they've removed the stringent lockdown restrictions, and so they'll be opening up, and they're likely to be buoyed by further support as well for the property market. So that's the general consensus view for the economic trajectory into 2023 across the regions. As we know, nothing moves perfectly in line with the consensus view, so it'll be fascinating to see how it evolves. But of course, there's another dynamic as well to pay attention to, which is the central bank monetary policy trends. Relatively homogenous moves over the past couple of years. If we think about early 2020 with the virus and the lockdowns, banks moved as a cohort to cut rates to as near zero as possible, in some cases to zero itself, to try and stimulate some sort of economic support. And then as inflation started moving higher, central banks all moved towards a restrictive policy, moving interest rates higher, and we're in this rapid interest rate hike cycle. There's discussions and questions about, are we moving towards peak rate hikes at this stage? Where is that neutral rate? But of course, different central banks are starting to diverge now in terms of their policy. Some are already looking to pause. Some regions in particular have actually already cut rates in places such as Turkey as well. Well, of course, other areas such as the Federal Reserve Central Bank or the RBA are still raising rates, but the question is, where are they going to stop and where will things land? Of course, the reason why this is so important to discuss the central bank policy is they're raising rates to try to curtail inflation. But raising interest rates is like putting a brake down onto the economy. If you hit the brakes too quickly, it can be difficult to restart. And so if they hit the brakes too quickly, they raise rates too much, we may go into an economic slowdown that's going to be very difficult to recover from. In terms of where that lands, nobody has the perfect opinion on it. Monetary policy operates with a lag, so you can't predict exactly where things will fall. But this is the discussions that are playing out at this stage. So where do things stand? It's been a torrid old year on the share market. The worst year since 2008. We saw the S&P 500 as a benchmark index down by 20% for 2022. The Nasdaq, the growth end of the market, down by over 30% as well. What's fascinating about this data is it's not often at all. In fact, it's extremely abnormal for the US share market to fall 2 years in a row. To give you an insight into just how abnormal that is, looking at the data, going all the way back to 1928, the US share market's only fallen 2 years in a row on 4 separate occasions. Now, to get an idea about the scale of these types of falls, one was the Great Depression, another one was World War II, another was a 1970s oil crisis, and then there was the dot-com bubble. So these are significant events. However, it's not to say that it's impossible for the share market to fall 2 years in a row, and if it does, we've got to be aware about this. Because looking at the data, we can see that the second year for these occasions, on average, is going to be worse than the first year. I think the US share market was down by around 20% for 2022. However, on average, the share market in the second year of falls across the board falls by 24%. So if this does happen, the pain that we saw this year, unfortunately, might be compounded. And another piece of data that's interesting is on those 4 occasions we talked about, 3 out of those 4 occasions, when the second year fell, there was a third year that followed consecutively. So we might need to be crossing our fingers here to see what the year of 2023 has in store. In terms of the consensus view for the stock market itself, it's a varied bunch, as you can imagine, due to the significant amount of macroeconomic headwinds. However, the consensus view seems to sit around the fact that we're likely to see more difficulties and a bumpy first half to 2023 on the US share market before potentially some sort of relief into the back half, though there's significantly divergent opinions on this, so there's not as much consensus in the back half. One reason for why this would happen is, of course, we talked earlier about the fact that the consensus view is for a US recession in the later part of 2023, and as we know, stock market bottoms generally happen much earlier than the macroeconomic bottoms of the recessions when the recessions come through, or the earnings downgrades and the earnings hitting their absolute lowest point as well. So of course, depending on how things play out on the economic picture, that could give us an insight into when we may see a bottom on the share market itself. Now, as we get into the risk for the market and the economy for the year up ahead, if you're enjoying the video, make sure you've subscribed and hit the like button as well to support the channel. But let's talk about the risks. There are a range of them and they're varied. But just having a look at some of these at a high level, of course, the recession risk itself, even if the recession view is consensus, depending on how long the recession is and if it's deeper and more protracted than we anticipate, this is going to be a headwind for the market too. Of course, the inflation discussion, yes, perhaps we've seen a peak in terms of the rate of inflation growth, but it doesn't mean that inflation's coming down immediately. So this is going to be important. We've talked about the central banks, and if they remain more hawkish than initially anticipated, of course, that's going to mean an uphill battle for the share market itself. Then on the other side of the coin, there's the geopolitics. There's a lot of uncertainty in the geopolitics front. The Ukrainian situation is still unresolved. Obviously, the potential for supply chain bottlenecks and shortages. And of course, the energy crisis too. Most namely in Europe, but we've seen the energy crisis and energy shortages flowing through to a range of different regions globally. Using that global lens, China is obviously reopening too. There's a lot of uncertainties about exactly how that will go and what that will look like for the global economy. And of course, we've got to talk about earnings. Earnings have been relatively resilient up until this point, but we've started to see earnings downgrades coming through and the pace and trajectory of those downgrades starting to pick up. Of course, as we know, as earnings start to come through and we start to see the earnings downgrades, that is going to be a headwind for the share market. In fact, a lot of analysts and economists are looking for that as well as a sign that perhaps we might be getting towards the worst of the period. And then, of course, the word of stagflation. If 2022 was a year of inflation as one of those key themes, a lot of economists are warning about the fact that we might have to be aware of stagflation. We know there's been a relatively resilient jobs market with unemployment being relatively stubborn too. Of course, we've seen relatively persistent inflation too. A lot of the central banks are predicting that's going to come down and come down relatively swiftly throughout 23 and 24, but we're yet to see that. But stagflation is something we need to be aware of. But of course, we can't only talk about the risks and the downside and think about only the negative side without considering the opportunities. That's what makes the market exciting, is there's always two sides to the coin. Of course, we know that volatility itself presents opportunities as well. But when we think about some of the potential opportunities for 2023, as we know, quality is going to continue to shine through. And quality companies are, by and large, going to be significantly cheaper than they were looking at the start of 2022. Of course, that doesn't mean that there can't be further for them to fall. But quality companies are looking on sale on a relative basis. When we're thinking about what does quality look like, there is a range of different key components, but some of those that many of the analysts have been talking about is free cash flow generative, and of course, those with margin resilience. Particularly if we're going to start to see further earnings downgrades, those with margin resilience are going to be worth their weight in gold. After an extended period of growth stock dominance over the past decade, many analysts are thinking about the fact that perhaps for this next stage of the cycle, it might be the value stocks' turn to shine. And then moving away from the equity market, there's been a lot of discussion from many analysts about the fact that bonds are back and that it might be fixed income's turn to shine. When we think about the fact that yields have finally started moving for the first time in a long time, it'll be fascinating to see how fixed income goes as a proportion of a portfolio. And then on the other side, this is really a continuation of a trend and feeds into the potential commodities supercycle discussion that a lot of different banks have been talking about. But commodities. Goldman Sachs recently put out a new report which stated that they believe that commodities will be another beneficiary in 2023 of the raw material shortage. And just to give you an insight into how bullish those they are, the Goldman Sachs report stated that the first quarter may be bumpy due to potential economic weakness. However, material shortages across the board will boost prices after that. Goldman Sachs is actually expecting the S&P GSCI Total Return Index to rise 43% in 2023, which would only build on the success of a positive year for the GSCI index in 2022. And then technology. How can we talk about the year up ahead without talking about the tech space? Of course, we all know the story. The tech stocks have been beaten down in 2022. Many of them have been the biggest victims of this valuation compression that we've seen across the board. Of course, we know there was a lot of exuberance and hype flowing into many of these names, so it seems like more of a reset back to more normalized levels. But it's worth noting the fact that disruption is still here and now. I'm sure if you think about digitization in your day-to-day life and think about how many digital products and technology and different online platforms you're using now in comparison to 5 years ago, it's been an exponential increase, and this is only going to continue to grow over the next few years and next decade. However, it doesn't mean that every single technology name is going to soar. Of course, we talked about it earlier on, but the fact that quality will shine through, but quality technology will eventually one day have its time in the sun again. Who knows when that will be? But of course, disruption hasn't gone anywhere. And in fact, we're only using more and more tech in our day-to-day lives. And so, after looking at all of those numbers, after unpacking all of that data, the question still remains, where does that leave us? If you want to hear what the experts say, Bloomberg surveyed a range of different strategists, and their average view for where the S&P 500 will land at year-end 2023 was the 4,078 level. At the time of this recording, that's around about 7% higher than where we currently sit, which of course would be a positive green year, which would be, I'm sure, welcomed by many after what has been a torrid year for 2022. But of course, nobody knows where things will head. We have seen that clearly throughout this year. Not many people were anticipating exactly where things would land, and we've got to be able to ride out the waves no matter where they sit. It's not going to be unlikely that we see a volatile year. We're going to have to get used to choppy markets, likely to go sideways for extended periods. However, it's going to be exciting. The markets have always got something to learn, something to unpack, and we're going to be talking about it all here on this channel. Love to have you join the community. If you haven't, make sure you head over to the Instagram as well, so you can keep up to date with daily news. Drop in a comment. Here's some other videos you can check out. Looking forward to 2023, but for now, stay well and happy investing.